discuss everything about securitization and SDIs as a product. Today we have Nikhil Aggarwal and Ashish Thekkekara with us for this discussion. Let me quickly introduce these two gentlemen. Uh, Nikhil Aggarwal is the. Just give me 1 second. There's some echo. 1 second. Okay, great. Sorry about that. So, Nikhil Aggarwal is the founder and CEO for Grip Invest, an alternative investment platform offering high yield investments starting at just rupees 1,000. Prior to Grip, Nikhil was a consultant with World Bank for their transport practice. Nikhil was also one of the co founders of Chalo, India's number one bus transport tech company, and a vice president in Morgan Stanley's investment banking team. Nikhil, welcome to this podcast. Uh, uh, Moving on to our second guest, Ashish. Ashish Thekkekara is a seasoned investment banking professional with over a decade of experience across origination, credit, and risk management, and other advisory functions. Ashish spent over a decade at Northern Arc Capital. In 2022, Ashish co founded Capital Stack, a neo investment bank dedicated to partnering with enterprises to address their capital needs through pioneering structured finance solutions. Leveraging his extensive background in managing lending portfolio exceeding 5,000 crores, executing over 100 structured finance transactions, and collectively raising over 50,000 crore rupees for his portfolio companies. Ashish has spearheaded Capital Stack's rapid ascent. Uh, in a remarkably small time period, the firm has emerged as a prominent influencer in India's financial services and structured finance landscape. So, Ashish, to cut it short, Ashish has a lot of securitization background. He's done over 5,000 crores or worth of lending portfolios and raised 50,000 crore plus in terms of its portfolio companies. A lot of it via securitization SDI. So he's probably the guru we needed for this webinar. So Ashish, pleasure to host you for this webinar. Thank you for taking the time out on a Saturday doing this live for our viewers.
No, thank you. Thank you for having me here. And it's a pleasure to be on this platform and looking forward to this discussion.
Thank you, Ashish. So for our audience, just to set some context, today, along with these two guests, we'll be discussing some key questions like what is securitization? Very simple question, but important question to understand. Why do banks or NBFCs, even go down the route of securitizing their loan books or, other key assets? What are SDIs, securitized debt instruments? Do SDIs offer better risk-adjusted returns than corporate bonds? Maybe they do, maybe they don't. Ashish has some interesting data to share, so we'll hear from Ashish. So stay tuned. Watch this webinar till the end. I'm sure you'll learn a lot. This is the fifth webinar in the AltXtra series, which is curated by Alt Investor that runs the largest community on alternative investments. So ensure you check that out as well. This AltXtra series is powered by Grip Invest. I am Yash Roongta and I'll be your host for this webinar. While I do discuss some key questions that I have outlined for this topic with these two gentlemen, I would request the audience to keep on putting their questions wherever they are watching this live. If you're watching this on LinkedIn, just put it in the chat box. If you're watching this on YouTube, there will be a live chat option. My colleague Megha is monitoring the live chat at all the places, and she'll pick all your questions and pose it to us, and we'll ask this group at the end of the webinar once we have covered all our questions. Okay, Nikhil and Ashish, lots of housekeeping already through. Ready to get started? Yeah.
Yep.
Okay, great. Ashish, coming to you because you're the guru of securitization. Let's start with the fundamental question. Can you try and explain to the viewers in simple terms, very, very simple terms, what securitization is?
Yeah, that's a lot of performance pressure with calling me guru, but I'll but I'll take a crack. So I'll try and avoid the jargons and the technical terms which we investment bankers make money out of, and keep it simple. Essentially, securitization basically is a method by which you can pool uh, different kinds of assets into tradable securities, tradable and marketable securities. Now, that's a very simplistic way. Now, to give an example of assets, primarily this could be receivables from loans. It could be receivables from leasing revenue. It could be there are interesting structured finance securitized asset transaction where you can actually securitize subscription revenue, right? Anything which there is future cash flow, which is potentially you can arrive at a or predict the nature of the cash flow, you can actually discount it and convert into securities and trade. So any kind of asset cash flow uh, gets kind of packaged, pooled, and converted into a security, and investors, whether it is institutional or individual, invest in those securities. So that's a bare basic of what a securitized instrument looks like.
Ashish, do you want to give an example, maybe a very, very small example of a, let's say, a car loan book that gets securitized?
Yeah. So I think the most common securitization transactions in India happens in the financial services space, where retail financing companies, the example you took of a car loan financing company or vehicle loan financing company, they give out loans to individuals to buy cars, and these loans, after a certain period of servicing, gets pooled into gets pooled. There is a due diligence by investor rating agency, and rating agency, based on the quality of the loans in the pool, provides securities to investors.
Oh, I think Ashish is stuck. Uh, okay, I think we have lost him. Nikhil, do you want to pick up that example?
Yeah, sure. So just
Is
Yeah,
am I
you're back.
back?
yeah, go
Yeah,
ahead,
you're
Ashish.
back. Go
Sorry,
ahead.
sorry. Where did you lose me?
Just you were saying that NBFCs give out loans and car
Yeah,
loans and
yeah.
they
So
get
so
pooled.
uh, so those car loans get pooled. There's a due diligence on the quality, the kind of loans get picked up in that pool, and there is a third party independent agency, which are credit rating agencies, who actually go through that pool based on the quality of the credit in those pool, give out a credit rating. It's an independent rating given by the rating agencies, which indicates the riskiness or the credit worthiness of the underlying borrowers. Once this is pooled and rated, there is an SPV which is created, which is a special purpose vehicle, which is managed by a trustee, which is a SEBI registered agency, which has a fiduciary responsibility towards the investors to manage the cash flows, the money coming in and going out to investors, the payouts, and the SPV essentially then converts these pool of loans into securities, and these securities are bought by investors. And this
Okay.
is once they are converted into securities, these are tradable on the exchange if listed, or off market like any other stock or a security.
Okay. Got it. Uh, I want to ask my follow-up question. That is, why do these banks and NBFCs go down this route? Because this sounds like maybe more paperwork, if I'm not wrong, or maybe an extra hassle to securitize. They can easily raise money via deposits or via corporate bond. So why go down the route of securitization?
So I think securitization is one of the ways of. I mean, and just to take a step back, whether it is NBFCs or banks or any institution, enterprise, they raise financing or capital through different means and different sources, right? For banks, it could be from capital markets like issuance of bonds, AT1 bonds. Deposits is the biggest source for debt for banks. For NBFCs, there is banks, institutional investors, retail investors. Now, when you scale up, you need to kind of diversify your sources of capital, and securitization is one of those products. The beauty of securitization is that this is one of the most ALM aligned. ALM is asset liability management, so it aligns with what your asset is and your repayment. So from a risk management perspective, for an NBFC which is growing, this is the perfect product which aligns with how you're getting money and how do you have to pay. right?
Hmm.
And typically for companies who give out longer term loans like vehicle loans or housing loans or a loan against property where the tenors are longer, securitization is a very good way to kind of raise capital which aligns with the loans they give out,
Hmm.
and ensuring that their risk on asset liability management is significantly reduced.
Hmm.
For banks, again, uh, I mean, right now in the last 1 year, given and we've seen reports saying that bank deposits have seen
Hmm.
all-time lows. That puts pressure on the bank's ability to kind of lend further, right? I mean, they have to raise those deposits to further lend to customers. So for them, this is one way to kind of borrow from the market. The other reason is also from securitization for NBFCs and banks gives a lot of capital relief. Capital relief essentially means that the financial services business, RBI stipulates a minimum requirement of capital to run these businesses. And as you grow and you borrow more and leverage, your capital gets blocked. And securitization is a very good way to kind of release that capital in an efficient manner. And securitization as a product is uh, very well defined from SEBI as well as RBI in terms of the guidelines which you have to follow, the regulations, the compliance. So it's actually, it looks cumbersome, but
Hmm.
the rules of the games are really clearly laid down. You just need to play the game within those rules. So
Got it.
it's yeah. So it sounds complex. It sounds fancy, and for investment bankers like us, it's a way to kind of go and pitch and sound intelligent. But actually, it's if you break it down, it's actually a very simple product, very well laid out by RBI, and because and one interesting fact, and people will find it surprising, like uh, fixed income market, while in India is actually very nascent, but globally fixed income market is 3 times global equity market,
Hmm.
right? So from a capital perspective, fixed income perspective, structured finance is a very big element of that globally.
Hmm.
In India, I think Nikhil and Grip is doing brilliant work in terms of democratizing that product. And I believe that in the years to come, we'll see a lot more happening. Just to give some statistics, I think as of the credit rating agencies who rate all the transactions estimate that the market in 2025 for
Hmm.
securitized assets would be 2 trillion in INR terms, which is
Hmm.
huge. And this is
Yes.
after, and this in my view, when you look at non-financial services market expanding, this will actually double and triple in the years to come. And
Hmm.
I'm quite excited about the potential of this market and the opportunity for Indian capital markets, which it will
Hmm.
open up vis-a-vis what we see in the global markets.
Got it. Okay. Thank you, Ashish. Although I do hope none of your clients are watching this webinar because they might not find you intelligent afterwards. Uh,
No, I think we want this to kind of become a part of all financial service companies,
sure, sure.
because uh, and I think it'll strengthen the ecosystem, right? I
Yeah,
think the more players come in, it will become mainstream, and there is price discovery which will happen, right?
got it.
I think market is the best way to kind of determine risk, price, and the capability of the ecosystem to survive. So more the players, better it is.
So, I mean, brings me to my next question very naturally. Who are the typical players in terms of the NBFCs or in terms of the banks that are operating in this space? And are institutional investors also investing in this asset class or it's just retail investors?
So traditionally, let me start with the second question. Traditionally, it's been the institutional investors who are leading this investment space,
Hmm.
because like you mentioned in the earlier discussion, that these products come across complex products, right?
Hmm.
So institutional investors have the mechanism to understand the risk, the compliance, and structured transactions.
Hmm.
And also, institutional investors have the capability to invest large amounts. And
Hmm.
for someone who's selling those portfolios, it becomes interesting to deal with them.
Sure.
Till the platforms like Grip came in, there was no way to aggregate smaller pools of capital to kind of invest in securitized debt instruments. So to give a flavor of what kind of players use SDIs to raise capital, NBFCs from a early stage investment grade or early stage NBFC who's just started and wants to look at diversified, even unrated NBFCs can actually get their instruments rated and get access to lenders whom otherwise wouldn't have lent to them because they were unrated. So an unrated NBFC or an entity can issue rated PTCs or rated securitized debt instruments and get access to capital which wasn't available for them. And on the other spectrum, the AAAs or the best of the best, the Bajajs of the world, the Mahindras of the world, also use this to kind of access different forms of capital because of the rating. I mean, one of the beautiful elements of securitized debt instruments is it can give you a higher rating than the entity itself, right? Through the structuring bit. So you're able to actually access more money from newer sources, and in many cases, limits are set based on the credit rating you have, and because you're issuing a higher rated instrument, your eligibility to borrow eligibility increases to borrow more. In terms and so cutting across a new emerging NBFC toward a large established NBFCs, everyone uses this as a product. From investor point, like I said, it was primarily institutional investors and ultra HNIs. Today, thanks to GRIP and platforms like these, there are aggregators who are aggregating this retail pool of capital, which was not available for these issuers. And I think this is a space which will grow. Fixed in everyone, and the best part is that this could be broken into smaller units because it's an instrument, right? Based on the face value you keep, you can actually go and buy one unit, right? Unlike a loan where you have to, I mean, no one will buy a portion of loan, right? You have to buy one loan together. Here, you can break down the loan itself into small units, like buying a stock, right? And I think the use case of in terms of the investors who coming in, this we see a lot more individual investors coming this and creating some allocation from in their whole overall investment portfolio. And I think so a mix primarily institutional investors, but we see a lot more influx of retail investors coming into the space. And I think sessions like these help in terms of for the investors to kind of understand the risk they're taking, the risk adjusted returns they could make, and more we do it, the participation we see increasing.
Yash, if I can just add to this, when we started at GRIP looking at SDIs, we saw that the market was about 2 lakh crores, which roughly is $20 billion. And when we looked at data for how many investors participated, it was just 200, right? So each investor was writing $100 million investment in this space. So there were 200 investors, including HDFC Bank, Axis Bank, ICICI, Standard Chartered, Citibank, and these were the large investors. There was not a single retail investor, ultra HNI family office that really had access to this. So I think it's been a fairly paradigm shift in the last, I would say, 12 to 18 months, maybe 24 months, for the kind of people who are accessing SDIs. It is still 99% an institutional investor base and probably 1% retail. Hopefully, alongside Ashish and many of the other OBPP platforms, we can start changing that.
Perfect. Amazing. So, Nikhil, let's come to you now. I mean, public, I am assuming the viewers more or less understand the gist of securitization. If not, it's converting, loans into tradable securities. These are loans that you are investing in. These are not loans that you are taking. Loan is being, taken by someone else. If that's sorry for my grammar, but you are basically funding those loans on the other side via a securitization model. So now that the viewers understand securitization, let's talk about SDIs. And Ashish has already touched on this a little bit, but can you just tell what SDIs are that you bring onto the platform? What are the different types as well available, and why is GRIP as an OBP player encouraging that option maybe more than corporate bonds per se?
Yeah. So what Ashish described is in industry jargon called pass-through certificate or PTC. Yeah, and this is an RBI regulated product, specifically when it deals to underlying loans as assets, where the NBFC is issuing the loan and then the securitization happens. Now, SEBI, as back as 2008, said that if this PTC needs to be offered to a wider set of investors, then it needs to follow also a process of getting listed on the stock exchange. Okay, because SEBI deals with investment products, and to make it investable, it needs to be held in demat form, needs to be listed. So SEBI created almost a layer on top of the PTC regulations, RBI's PTC regulations, called the SDI regulations or Securitized Debt Investment Instrument. It allows the PTC to get listed and then offered to retail investors at a minimum investment amount of 1 lakh rupees. In a way, an SDI is nothing but a PTC. So it is also an RBI regulated instrument and a SEBI regulated instrument that can be offered to retail investors. Right? It's as simple as that. What you're buying underlying is the same product that what Ashish and I spoke about, which is an HDFC, Standard Chartered, Citibank buying into, except SEBI has now regulated it for retail investors. Funnily, it's been done as old as 2008, but it has only been really in the last 2 years that this market for retail investors has opened up alongside the OBPP regulation. Um, you know, Yash, to your second question, and Ashish talked about it, the beauty of the PTC or SDI, and maybe for simplicity, I'll just call it SDI. The simplicity is that any form of cash flows can be securitized. Underlying could be loans. These could be personal loans. It could be vehicle loans, gold loans, car loans, housing loans. But it could also involve things like lease rentals, right? Subscriptions. And hence, at GRIP, we have focused on creating multiple varieties of SDIs depending on what the underlying cash flows are. The three most popular SDIs are Loan X, where it is an underlying portfolio of loans. This could be different types. Second is Lease X, where the underlying is portfolio of lease transactions. For example, a fleet of electric vehicles leased to Blue Smart, and the lease rentals being securitized. And the third is Invoice X, which is a pool of invoices which are being securitized, right? So these are three popular SDIs on our platform. To the last question you asked, I would say that the SDI was also a discovery for us. We did not,
Sure.
because it was not a common product, we also didn't know about it. And when we identified the SDI as an instrument in 2022, we realized what a great risk reward it brings to the platform. Okay, as Ashish mentioned, for the same rating, the risk reward, the SDI inherently gives a better return. Okay, at the same time, it is completely regulated both by RBI and SEBI. It mandates you to have a independent credit agency to look at it. It's held in your demat account. So it ticked all the boxes that a great investment product should look at. And then when we went back and looked at historical data, we saw that the performance of SDIs across the industry has been incredibly solid, right? So for example, and Crystal published this data a few months ago, they published data for SDIs issued since 2018, even before the crisis from COVID, and not a single one of those SDIs has actually had a delay or default. So when we came across this product, it became very obvious to us that this is exciting for retail investors, and it's a shame that they have not been able to access it till now. We wanted to solve that gap.
Okay. Thank you, Nikhil. When you were answering that question, you mentioned better returns than corporate bonds. How can SDI deliver better returns? And let's talk about the security features as well. How is it maybe more safer than corporate bonds?
Yeah, maybe I can start this answer, and Ashish should add. Ashish has also
Yeah.
done a lot of
Sure.
research on this topic. But maybe I can explain the security feature of SDIs and hand it over to Ashish. So we mentioned that this is a RBI regulated product, and RBI hence documents that there should be certain types of securities in this instrument. Number one, and I'll try to stick. I won't go into the gory details. I'll just stick at a slightly higher level today. Number one, the RBI says there should be the loans in the pool should be of a certain quality. For example,
Sure.
they cannot be bad loans. They cannot have they cannot have any delay, right? You cannot, as an NBFC, say that I will move away my bad stuff into this paper. That's not possible. In fact, you can only securitize what is good. Okay, so there are certain criteria like this that RBI has applied. Number two, every SDI that comes on our platform and that we have come across typically has three security features. Number one, there's a cash deposit or a cash collateral which exists, which is typically 5 to 7% of the SDI amount. Second is what is called over collateralization. So if you're investing 100 rupees, the assets secured assigned to you typically are about 112 to 115 rupees. So
Hmm.
there's an over collateralization. And finally, something called excess interest spread, which is the excess interest being earned by the NBFC on these loans, but is first provided to you as protection. Okay,
Hmm.
these are the three security features part of an SDI. One way for investors to look at is to say these three security features add up to maybe 25% of the SDI amount. Against that, what is the typical default rate or NPA rate of the NBFC? Okay, if the security is significantly higher than the GNPA or the net NPA, then at a high level there is a sufficient cover in this SDI. Yeah. I'll stop here, Ashish, but you have far more experience, so I'll hand it over to you.
No, I think from a risk management perspective, one more element I think I would like to add is that uh, one of the features of a securitized debt instrument is that it's bankruptcy remote. And if I have
Hmm.
to put it in the simplistic term, that say when you invest in a bond, the liability of paying that bond lies with the issuer or the company. And if anything happens to that company, you may not get your money back, right? Or you'll go into a IBC and all of that. The nuance in a securitized debt instrument is that once that pool of loans or cash flows are identified, those are ring fenced from any of such solvency risk. Right? Even if the company goes down because of operational issues, and as long as these pool of loans are repaying, the investor can actually get back that money. And that's why in terms of, and when you talk about more about who are the participants, we will delve deeper into this of how this is how this comes into practice. But just to go back to in terms of from a yields and the risk adjusted returns. So at Capital Stack, we actually analyzed securitized debt instruments, especially primarily for financial services and NBFCs since October 2020 and till December 23. So in that those a period of 3 years, what the data spoke was that uh, a, a capital market instrument like a bond or NCD of a similar rating as vis-a-vis a securitized debt instrument gave lower returns or yields to the investor.
Hmm.
So which essentially means that a A-rated securitized debt instrument gave better returns to the investor as compared to a A-rated NCD. Plus, a securitized debt instrument had like all the features which Nikhil spoke about in terms of credit enhancement or cash collateral, excess interest spread, the equity which the company which is pooling the loans, their share of risk or skin in the game also, that if they don't collect, they'll lose money as well. That's the biggest right. It's not that I have sold it to you and I'm
Sure.
free of this risk, right? So the skin in the game, and from a risk adjusted return perspective, what we the data gave us insights was that securitized debt instruments actually in certain rating category gave returns as high as 200 basis points. That is 2% over what a
Wow.
bond would give, right? And that was eye-opening for us, because you would from a distance would say that, okay, companies issuing a debt, how can it be different? But the power of securitized debt instruments was that from a risk-adjusted return perspective, it always stands out better. And at least in the last 3 years, that's what the data speaks. So we did a little bit of research in the international market also. We got a similar trend, but the difference wasn't this glaring as it was in the Indian market.
Hmm. So Ashish, why does that happen? Because we talked about all the fantastic security features which make the product overall less risky. Why is the product still offering a better return than, corporate bonds? Is that because the market is small in India right now? Because you just mentioned international markets, the difference is
Yeah.
less. India, it's higher. So
Yeah. So
why does that happen?
yeah. So I mean, you kind of answered that question. I think the participants from a capital available for this product is still emerging, right?
Hmm.
The incentives to invest in these products, primarily in the financial services space, was driven by the priority sector requirements,
Hmm.
and today it's expanding. And as any market-based any capital market, when the buyers and sellers are and it's a supply and demand squeeze, right? So
Hmm.
when the participants increase, it'll kind of taper down and come to similar levels.
Hmm.
But I still think that in the years to come, securitized debt instruments will command slightly higher premium from a yield to investors vis-a-vis direct bonds or NCDs.
Very interesting. Okay.
I
Because
just,
I mean, yeah,
if I could ask a
go ahead.
follow-on question, Ashish, because the NBFC is of a lower rating in an SDI as compared to the SDI, do you think that's also a factor because the cost of borrowing for the NBFC is still competitive, right? Um, of the because they can pay higher on the SDI because their overall cost of borrowing is higher. Is that another reason?
I think uh, yes and no. I mean, the cost of borrowing, usually the overall cost to the issuer works out very similar.
Hmm.
uh, uh, because there are additional issuance costs in a capital
Right.
market instrument, which adds on to the apart from the investor yield itself. So there are leakages which the entity has to pay over and above the interest rate to the investor, uh, uh, and that kind of brings from a borrower perspective or the issuer perspective, it's almost comes out to the similar range. But there is also there are issuers who from a diversification perspective are okay to pay some premium, because when you're growing, you need to kind of plan for the future and build that pipeline to raise capital. Uh, uh, Also, like I said, talking in the earlier discussion, SDIs are the best aligned product from an ALM perspective, right? Not necessarily that the capital market instruments which you're borrowing from market are aligned to that ALM. So you
Sure.
get some premium for those. So it's a market-based instrument. So a lot of price discovery happens. Supply demand is a very very big element.
Okay. Okay. Thank you, Ashish. Ashish, another question. Has there been any instances where an issuer has issued both, let's say, corporate bonds and SDIs, and the corporate bonds, the issuer went bankrupt, and the corporate bonds faced a loss, and the SDIs were left untouched, like they didn't default? Any instances like that?
Yeah. In fact, this my previous example about the bankruptcy remote element or ring fencing these cash flows is the was put to test, put to
Hmm.
litmus test in this case. Take an example. We all know Diwan Housing or DHFL. It was a
Hmm.
AAA rated institution, which is the best, highest rated instrument. And that company went bust and went belly up because of governance issues. And they had issues. Their NCDs or bonds were also rated AAA,
Hmm.
higher than many of the public sector institutions. or even state governments for that matter, right? And it was the best credit quality bonds which went past. But parallelly, they had also, from a diversification perspective, had done securitized debt instruments bought by institutional investors. Now, that this is a case where, because of the bankruptcy remote nature of the product, while the company went belly up, the pools of cash flows and underlying loans are performing well, and those pools and the cash flows from those loans repaid the investor. And because of the credit protection, whether it is the cash collateral or the excess interest spread or the equity share, which Nikhil spoke about, that gave the buffer to absorb if there was any weakening in the underlying credit of the underlying loans. So there was enough buffer, even if the underlying borrowers delayed payments, to kind of to ensure that the investor got their money back on time, and in some cases faster than what they would have assumed. Right. So I think that is this is a case where bankruptcy remote nature of SDIs were tested in the courts, and successfully kind of it stood the test of time, stood the test of law, and that is a big validation for the marketplace, that why securitized debt instruments are critical for building and scaling debt capital markets in India.
Very interesting. Very interesting. I mean, a AAA issuer going bust, but the SDIs were untouched. Who
Yeah.
can think of that, right? Uh,
Yeah.
okay, Nikhil, coming to you now, because Grip is the market leader for SDIs in retail investor category right now. Let's talk about risks in SDIs. Any downside of SDIs from an investment perspective? I mean, what should retail investors really think about before they make their investment in this product?
Sure. So I'll keep aside, general risks of investing, and obviously this is a fixed income instrument as against a market linked instrument. So those are different attributes. But as someone, generally wants to invest in this space, um, I think there are a few things. SDs are, and you've heard it from Ashish, are generally more secure than corporate bonds for the same level of rating. But if an investor wanted to cherry pick and wanted to really select an SDI to start with, you could maybe look at two things. Number one is, what is the underlying loan, right? So, for example, we recently did a SDI which was loan against property. So the underlying loans also were secured because they were backed by property. And those loans, or that SDI, could be considered by certain investors to be further protective, right? So that is one thing to consider. Same thing for loans against vehicles. The second I would add is that obviously the rating is important, and hence we offer a range of ratings between, I would say, a triple B plus rated SDI all the way to an A plus rated SDI. And if an investor is looking, maybe they can start their journey with a A plus rated SDI. The last thing, not from a necessarily risk perspective, but important differentiation, is the TDS. The TDS for an SDI is 25% versus TDS for corporate bonds at 10%. Now, the ultimate tax treatment is the same for both. It's marginal tax rate and makes no difference to the investor. There is a bit of cash flow difference that gets created, but more than offset by the higher returns for the same rating and the higher security package.
Okay. And Nikhil, how is the liquidity for this product at this stage?
Yeah. No, thanks for mentioning that, Yash. The liquidity for all fixed income products today is quite limited in India. It's for all the reasons that Ashish and I are focused on building this business and the capital markets. I think generally liquidity. If you went to, while these are listed products held in your demat, and you went to the stock market to try to sell them, you are unlikely to find a buyer, right? So many of us are very comfortable with equity because we can sell it. That is not yet true for fixed income products like corporate bonds and SDIs. At Grip, we've actually launched a beta program for liquidity, which allows people to sell back bonds bought from us, and we're hoping to scale it. In general, my view is that SEBI is taking incredible steps to increase liquidity in the market. One of the biggest actions they've taken is to allow corporate bonds to now be issued at 10,000 rupees, privately placed corporate bonds at 10,000, which will encourage more retail participation and drive liquidity in the market. So maybe 12 months from now, when we do this session again, I'll have a different answer. But today, yes, liquidity is limited. Investors coming in should think about being invested for the full period of time. Because SDIs pay interest and principal monthly, a lot of your capital comes back quickly, and hence liquidity may not be that much of a concern in the first place.
Okay, got it.
Can I
Ashish, you want to
add
add something? Yeah.
yes, so I think just taking a leaf from what Nikhil said from the regulators push perspective, right? While this is a fixed income product and not you don't have liquidity market access like a share, uh, SEBI is pushing the industry to actually get onto a digital platform like the EBP, right? Electronic book building mechanism, where for at least started with bonds, where there is a bidding process. A company calls out for bids for subscribing their NCDs or bonds, and investors can actually go and put in their bids. Very similar to what happens in the equity markets. Given that it's in a nascent stage and debt market capitals are still very shallow, I think even in the years to come, this will become a big element to kind of provide liquidity, and more fixed income products will come into place. In fact, a couple of years ago, RBI had floated a discussion paper for a similar platform for securitized assets as well. For housing loans or residential mortgage backed securities or securitized debt instruments, housing finance companies and the regulator has set up a company to kind of promote this more, where they will actually invest in these assets and create a secondary market eventually. So I think the good work which Nikhil and other platforms have started, I think the regulator is pushing the larger players in industry to kind of move towards that, and the risk of liquidity in the years to come will kind of, I'm hoping that it will be addressed to some extent.
Got it. Okay. Thank you, Ashish. Ashish, my last question to you, because tons and tons of questions from the audience, very curious audience this time. Uh, uh, the last question to you is, SDIs are a fantastic, way for the investors also and for the companies also to raise debt because of, ALM preferences. But the market is still small. What, according to you, will accelerate the growth of SDIs in India? And, what role can retail investors play in that growth?
I think Yash, you are playing a big role in scaling this market. I
This
think
is not a paid ad,
seriously,
guys.
no, this is not a paid guide at all. I think the first step is education, right? Awareness about these products existing, and also creating a regulatory ecosystem where multiple players, ecosystem players, are coming together and promoting this. Like the example I took about the residential residential mortgage-backed securities, right? The ecosystem players have set up independent company as shareholders to promote this, and we see that
Interesting.
this will happen across the space. From a retail investor space, I think awareness, performance data, solving for liquidity to some extent, all these, and a little bit of innovation in terms of how cash flows are managed for them, right? I think all of that. SEBI has done the example Nikhil took about breaking down the ticket size to 10,000, right? The face value. I think steps like those will really help. I think those are initial stages, but our discussions and engagement with the regulators, both RBI and SEBI, they both are very clear that they want to kind of deepen the debt capital market in the country, because we are only scratching the surface. There is so much untapped capital which can be kind of brought into the space and give impetus to the growth which we are all working towards for the next couple of years as a country.
Anything to add, Nikhil, to that?
Not really. I would be sort of
Okay.
re-emphasizing the same points. But to me, I would just put awareness back on the top. A lot of the other stuff is now solved for in a way that can in the market is good. It's good enough for the market. I think the awareness is the big challenge. Some of the question, like if you look at the US market for securitization, it's just incredible, and it's been there for 20 years or 25 years. I don't think we have seen that kind of penetration happen in India, even among, say, for example, mutual funds, right? I think the participation of mutual funds also in SDIs can be far greater, but does not happen. So I think there is an awareness required not only retail but across the board for this to market to increase in size.
I mean, to Ashish, I'd like to ask you that, given your experience working with all the institutional investors, also, why do mutual funds not invest in this asset class?
So actually, mutual funds do invest in this asset class, but because they deal and their allocation for financial services particularly is limited, especially
Sure.
after the ILFS era. But they are, in fact, way back in 2010 when securitization started in the microfinance space for the first time, the biggest investors were mutual funds. Because of the reason that they understood complex investment products, and they were best suited to kind of invest in those products. So for larger issuers in the secured asset space, mutual funds are big investors in securitized debt instruments. Uh, and I think they play the big ticket size game where only the bigger players get qualify for it. That's why we don't hear a lot about them.
Possible.
Foreign banks are because if you Google, Goldman Sachs, Credit Suisse, you will see every 3 months they're doing a large transaction in the country. JP Morgan, Barclays, Goldman Sachs, Credit Suisse, all of these are big buyers and investors in securitized debt instruments, and they actually sell this to international offshore investors
Sure.
because of their wealth network.
Got it. Okay. Thank you both. I think we should move on to the questions in the interest of time. Lots and lots of questions. Nikhil, first question to you from Seva Kumar. Is there risk of non-repayment in case of SDIs?
Yeah, so Sivakumar, there is always a risk of non-repayment, as it is true for any other investment instrument. I think the risk mitigants are quite high in the case of SDIs, as we have spoken on this session before, and typically about 25% of the SDI value is in some form of security. One of the things we do for every SDI is we run sensitivity analysis to say how many underlying loans have to default or delay for an investor to not get paid back. And typically we see that even if 40 to 50% of loans get delayed, the SDI will still be able to repay investors. So yes, I cannot say that this is a risk-free instrument. That's not the takeaway. But yes, there is a lot of risk protection that is available in the SDI, which is why historically there has been, at least for the last 10 years that we have seen, and Ashish talked about this, there has been no impact even if the underlying NBFC had a default.
Okay. Thank you, Nikhil. Ashish, next question to you. I think we talked about skin in the game for the issuer of SDI. Can you explain what that skin in the game is?
Sure. I'll take a small example. So if the company, in case the NBFC is pooling their retail loan portfolio of vehicle loans worth 100 rupees, when they are when they are pooling this and selling it to an SPV under SDI, the SPV doesn't give them 100 rupees as it is. They actually give them, say, 90 rupees or 85 rupees. The remaining is their share or their equity in the business. It's like when we go and take a home loan, the bank doesn't give us 100% of value of the house. They say that put your share 20% or 15%, right? Because it's my commitment that into that asset. It's the similar way, and that is something called the over collateralization or equity tranche in some of the structures, which the issuer has to put in uh, to give cushion to the investors, and that also acts as an additional buffer to enhance the rating, apart from the hard cash collateral kept in a separate bank account, which is lien marked to the SPV itself. So
And that is
that
also
money
posted by the issuer, right?
that is bad. So that's actually hard cash kept in a bank FD, lien marked to the trustee of the SPV. So the
Okay.
issuer, even if they want, they can't touch that money until the investors get paid and give an NOC for it.
Got it. Okay. Um, Nikhil, next question to you is: are all these instruments regulated? And if yes, which regulator regulates such instruments?
Yeah. So all instruments, all SDI instruments are regulated. If the issuer is a NBFC, then these instruments are regulated by RBI. If the instrument is whether instrument is listed, then not only is it regulated by RBI, but it is also regulated by SEBI. So that is the coverage that exists. As Ashish mentioned, they are also all rated. So they are all rated by agencies like CRISIL and ICRA. And just covering a few other questions I saw, all of these instruments are held in DMAT form because they are largely listed instruments. Even if it's unlisted, it's held in DMAT form.
Okay. Another question for you, Nikhil: how is GRIP earning in all of these, downselling the SDIs?
Yeah. So we typically do the work of going to an NBFC and structuring a PTC or an SDI. Uh, we do detailed credit analysis. We get the details of the loans, cherry pick them based on quality, go to the rating agency, create the SDI, get it listed, etc., etc. For that purpose, the NBFC typically pays us a processing fee, and that processing fee becomes GRIPS revenue.
Okay, fair enough. Ashish, next question for you. It's a bit technical because you're the guru. The question comes: so for bonds, violation of financial covenants leads to immediate repayment to investors. However, for SDIs, if there's a violation of any form or covenant, uh, the excess interest, uh, which is the margin taken by, no, sorry, I think the excess interest is required to be paid to the investors for faster repayment. Ain't that a inherent weakness of SDI? I think that the individual has also said that the excess interest is taken by GRIP. I don't think that's the case.
Yeah,
Yeah, but
in fact, I noticed that question, and I was hoping that we discuss this, and I think it's a brilliant question.
hmm,
And I think whoever asked this question, I think is suited to do structured finance. I think,
okay.
right? So I think it's a very, very, very valid point, saying that in an NCD you can actually covenant and put thresholds that if you breach this threshold, you have to repay my money. Even in SDI, you can actually, when we structure transaction and when we work with GRIP also, we've seen that they also do. They actually covenant the issuer as a issuer to the or originator, and there is also, we break it down in terms of one is someone who's originating loan, and second someone who's servicing those loans. In most cases in
Hmm,
India, they both the activities is done by the same person. But when
hmm,
we structure the loan, securitized debt instrument in legal documents or contracts and agreements, we ensure that each of these roles are defined and there are thresholds set within the documents for utilizing that excess interest rate. So if they breach any of this in many of the transactions, that excess interest rate can actually accelerate repayments to investors. So nothing will go back to the originator unless the investor gets paid. Uh, so
hmm,
so so it may not happen that they'll repay everything on next day, but it'll fasten the repayment and the cushion available to the investor from a risk management perspective. And those are structures, different ways to kind of capture that thresholds and roles captured very clearly by structurers and arrangers in this business.
Yes,
Okay.
I do want to clarify on the on the excess interest spread point.
Yeah.
And we didn't talk about the role of trust, but none of these cash flows from SDIs flow to GRIP, right? I think that's very important for users or for potential investors to understand. The way the regulations exist today is that a separate independent trust has to be created or a trustee has to be set up, which is separately a SEBI regulated entity. And all cash flows, whether it is returns, EIS, triggers get done, all happen through the trustee. And so there is no dependence on GRIP for then making the payment. And that's a massive amount of security measure being put in place by the regulator.
Okay. Okay. Great. Ashish, one more question for you. You said SDIs can be broken down into pieces. It can be broken down into like right now the SDIs are getting offered at 1 lakh rupees. The question is why can't be broken down further?
So I think, and Nikhil, if correct me if I'm wrong, I think you can break it down into smaller units, but it is from an operational point of view, you keep it at a certain size because otherwise it will become unmanageable for the trustees to the intermediaries to kind of service those investors.
Yeah.
Uh,
So, Ashish, you're right. We have seen SDIs with are broken down to 1 rupee,
yeah.
and so you can really break it down. However, guidance from SEBI today is that if they're offered to retail investors, minimum investment amount should be 1 lakh rupees. So even if it's 1 rupee, a user has to then buy 1 lakh units to make it 1 lakh rupee ticket size. Um, like in the case of bonds, where SEBI has reduced ticket size from 10 lakh rupees to 1 lakh rupees to now 10,000, we are hopeful that over as this market develops, the same will happen also for SDIs. But today at a retail level, it is a 1 lakh rupee investment.
Okay, so it's more of a regulatory thing rather than an operational thing right now. Okay. Uh, Nikhil, do we have the CRISIL report on the SDIs that you earlier spoke about?
Yes, we do have that, and if the concerned listener can send us their contact details, we're happy to share it with them.
Sure. Okay. Uh, just sorting through the questions. We have already talked about skin in the game. Another question from Mithilesh Rathi for you, Nikhil. Is invoice discounting also SDI?
The simple answer is no. Invoice discounting, which I guessing you're referring to, is what happens or is offered by several platforms, where you buy into a single invoice or pool of invoices or a number of invoices against a particular merchant. That product actually is not a regulated product. Neither is it regulated by SEBI nor is it regulated by RBI. And none of the features of securitization or SDI that we spoke about are applicable to invoice discounting. What Invoice X, which is a SDI product that GRIP offers, is where 500 invoices are pooled together and the receivables from those underlying loans are then brought into an SDI structure, and all the good things about security package, regulation, rating come into play. So Invoice X is a form of converting invoice discounting into an SDI product, but invoice discounting by itself is not a regulated product and is not a form of SDI.
Okay, got it. Uh, Another question is what will happen, again from Mithilesh Rathi, what will happen if some loans become NPA after the issuance of SDI? Ashish, do you want to take that?
Yeah, I think Nikhil briefly touched about it in one of the examples he took. So, because of the cushion available through the EIS, the cash collateral, and the over collateralization, even if there are loans in the underlying pool which are delayed or go bad, the all these protections are usually are sufficient. Or even when we structure a transaction, we keep in mind, and like Nikhil said, we do testing and size up those cushion, keeping in mind the past data of the issuer, the how the economy is doing, sectors are doing, and the numbers are the thresholds are set in consultation with the credit rating agencies to ensure that there is enough buffer and cushion to absorb losses, at least significant losses to a certain extent. And like any investment product, nothing is risk free. There are a slight risk. Even a FD with bank is not risk free. Even though there is insurance, but when you get the payout, you never know. We've seen that in PMC case. So there are risk. There will always be risk, but the whole point of securitized debt instruments is to kind of mitigate those risks and put structures so that whatever cash flow the pool is generating, it is prioritized for repayment to the investor.
Okay, got it. Thank you, Ashish. Nikhil, a very specific question regarding Grip platform. A user wants to talk about the existing SDIs of Grip. Where are they on the risk reward scale? And what is the kind of liquidity that is being offered by the platform right now? And what are the typical size of issuances?
Sure. So actually today, I was just looking at the platform and I saw the question. We have about 8 SDIs on offer. I think it's exciting to be able to offer that much variety. The rating starts from triple B all the way to triple A. So we've got the full range of ratings. There are products which have a 4-month tenure to a 45-month tenure. So also whatever you want to invest in. Underlying assets range from personal loans, NBFC giving out personal loans, NBFCs linked invoice discounting, as well as an SDI which is backed for home loans, LAP loans. So whether it's tenure, rating, or even the underlying, actually the platform is offering all those options. That's a big philosophy for us at Grip. We want to offer you options. And the returns on these products range between roughly 11% to about 13.5%. So a good range of returns as well. In terms of liquidity, and like Ashish said, if you compare the same rating of SDI to a bond, you will see about 150 to 200 bips or 1 to 2% higher returns on the SDIs that Grip is offering today versus the corporate bond. The typical issuance sizes that we do are between 10 to 25 crores. That's per SDI. And then these are available for investment at a minimum investment amount of 1 lakh rupees. So that 25 lakh transaction is then converted into a 1 lakh rupee transaction. In terms of liquidity, we today do not guarantee liquidity on SDIs. So if you want to sell it, we don't guarantee it. But yes, if you do need an exit, please contact us. We'll be able, we'll try our best to make sure that we're able to offer it, but we do not guarantee it today.
Okay, fair enough. Thank you, Nikhil. I have a KBC style question for you, Nikhil. Somebody has asked, why did Grip Invest choose debt as an investment product for the platform? Option one is because debt is a safe investment. Option two is because it provides you high return opportunity. Option three is debt market is a big market. Or option four is, debt market is the chances of building a potential investment platform in the debt market is higher. So
I'll add option E, all of the above, which is truly what the answer is. So whoever's asked the question is bang on. I think it's actually a sum total of all of these things. Um, it it frustrates me, if I can use that word, to see how we've unable as Indians we're unable to use the debt market or fixed income market to build a good portfolio, to build returns. There is $2.5 trillion lying in fixed deposits. Okay, and some of that money should earn higher returns, right? And I'm talking about myself as well. That's how my portfolio was before Grip happened. And I think there's an opportunity here to solve that for Indians at large, and at the same time build a large business, but also solve a real problem that we are seeing with Indians. With no disrespect, we celebrate IPOs, every IPO that happens in the country. There was massive news last 2 weeks about the Ola Electric IPO, but when you realize that for every equity IPO, there are 6 equally large debt IPOs that happen, and no one hears about them. we're obviously missing something out. So we believe there's a real problem to solve as a combination of awareness and access, and that's the mission of GRIP.
Awesome. Sounds exciting. Uh, I think we are running over time, so I'll just pick up the last question again for you, Nikhil. What is the taxation on SDIs? And I think you have already briefly covered it. But is the gentleman has asked if what is the taxation of invoice X as an instrument as well, and is it different from invoice discounting?
Sure. So the taxation on both is actually the same. Like most fixed income products, there's a marginal tax rate that you pay on interest income. That is same true for SDIs and corporate bonds, and also I think for invoice discounting, whatever interest income you earn, you pay a marginal tax rate on it. However, TDS is different, and TDS, if you understand, is deducted before payouts to you. It is then adjusted when you file taxes. So TDS in case of SDIs is 25% versus 10% for corporate bonds. That's the difference. That's the only difference in taxation.
Okay, great.
I think one nuance, yes, if I could add, I think the
Sure.
only nuance is that because these are securities and if you sell these before maturity, there is an element of capital gain tax, right? Depending on the holding and whether it is listed or unlisted and the tenure you holding it for. But if you kind of hold it till maturity and the interest, the tax on interest is very similar to any other fixed income product.
Got it. Okay. And I think in the current budget, uh, I think the debt securities had a favorable tax treatment, if I'm not wrong, at 12.5%.
Listed debt securities.
Yeah, that's what GRIP offers. I mean, listed stuff, right? So, great. Okay. I'm sorry if we have not been able to pick your questions. Please feel free to reach out to Nikhil or me via the emails. We are happy to help. You're free to join the Alt Investor community as well. Uh, we can answer all your queries there. My colleague Megha will just post the link to join the community as well. And uh, happy to answer any questions that you have. But thank you to the audience who joined this webinar. Thank you to you both as well, Nikhil and Ashish, for sharing your insights. Ashish, you especially, the guru for securitization. But if you like this webinar, please don't forget to like and share this video. As you heard from both these gentlemen, awareness is important. Bring your friends, family into this asset class if it suits their risk profile as well, because what good is money sitting in a fixed deposit if it's not even giving you inflation beating returns, right? So take that extra risk if you can and invest in higher yielding products. For more insights, more information, there is always Alt Investor community, or if you're on the GRIP platform, there will be an RM assigned to you. Speak to that RM, understand what these products are in greater depth if you want to, and then make your investment decision. Thank you again. We'll see you in the next webinar. Thank you.
Thanks so much, everyone. Thank you.
Thank you, Yash.
Yes.
Thank you, Nikhil. Thank you.